Okay, welcome to JMC vLearning. Today we are planning to discuss about our main topic. This topic will be related to the question number 7 mostly when we are analyzing the AAT 3 Management Accounting Finance subject. Then there is a question number 7. Majority of the question will be available in the question number 7. This is our topic today. We are planning to discuss cost of capital. Normally we call as COC. This question, when you are analyzing the past papers, generally this question will be available in the question number 7. In recent paper also available in the question number 7. Previously also when you are studying, there is a question number 7 related to the cost of capital. Okay, we will discuss about this chapter mainly. What are the sources of funds? This will be called financing. Under the management accounting, we are talking about the financing. That is the sources of funds. Sources. What are the methods we can collect in money to the organization? Okay. Then we can call sources. What are the methods? That means we can say that is the alternative words, methods. How to collect in money to the organization. In here we are having 3 separate sources. First one, equity capital. Other one, debt capital. Other will be the short term. These are the long term. These two we consist as the long term financing method. This is the short term. Under the short term, as example, overdraft, then short term loans. Likewise, we can collect in money. In here, in our syllabus, in the AAT 3 syllabus, this topic will not consist in our calculation. We are mainly focused about the equity capital and debt capital only. Okay, this is the mind map, that is the short note. Then you can memorize what are the area in this topic will be consist. Second, these are the sources. These are the sources we can collect in money. Thereafter, we have to know about what are the cost for these sources. That means when we collect in money by using these methods, then we have to bear some cost. That means we have to incur. Under the equity capital, this equity capital, you should know about that means you must know about how to account in these equity capital under the financial reporting. That means under the financial instrument SLFRS 9, LKS 32. Then those standards mainly consist about how to account in this equity. Based on that, we have to identify the cost, that is the expenses. In relation to those methods. Under the equity capital, normally it is available under the ordinary share capital. Ordinary shares, OS. Other one is preference shares. Here we think about the irredeemable. Here, under the debt capital, there are 2. First one is the preference shares, irredeemable. No? If it is redeemable, preference shares redeemable. Then this will be coming under the debt capital. Why? If we obtain some funds from the particular funds provider, then we have to have settled as soon as possible or mention in the particular period, specific period, certain amount, certain period if we obtain, then that is the obligation. That's why we call as the redeemable. Redeem means we have to settle in the near future based on the agreed terms. Here Irredeemable means that is the opposite word, that is the antonyms. It will be called as if we collect funds from the particular funds provider, we can stay, or that means we can take that funds as far as our purposes, not their request. That means particular funds provider request money in certain time period, then that is the redeemable. There is no time period, that means we can take that funds as soon as possible to our requirement, then those called as the irredeemable. Ordinary share also having the same kind of features in relation to the preference shares in the irredeemable. Other one will be the debt. Debt means normally bank loans, debentures, hire purchases. Likewise, in our topic, not talk about the bank loans and hire purchases, only consider about the debentures. Then we will take a short note. What are the main area we have to discuss about the in complete our question number 7. Ordinary shares, preference shares, redeemable preference shares, under D, debentures only. Those are the area we have to be careful when evaluating the questions. Okay. Then cost. If it is a cost, then we have to mention how to identify the ordinary shares cost. Normally we can say KR O R E. I will explain in later. This is the mind map overview of our discussion. Then I will explain why we are taking the KR RE likewise. Here KP O R P. Here also KP RP. Here KD cost of debt, return on debt RD. I think all of you can see this abbreviations. Keep in mind those are the main cost identification. If it is the cost is available those sources, then we have to be mentioned by using the abbreviations. We can say in or that means, for example, we can say on behalf of the ordinary shares RE. RE means return on equity, and otherwise we can say cost of equity. That are the word we can use. Preference shares. Preference shares mean that is shares given to the preference to those fund providers to collect their money. That means if we obtain as an organization, in my point of view, I will collect some money from your side, from you. Then you will be provide money to myself. Then I collect money and I have to use my cost of ordinary activities. Then particular funds provider will request to their money certain period. Some providers will not take as a serious. If I am in a possible to settle, then I can settle. Those are the irredeemable. Redeemable means whether I am not available or not, I have to committed those things. That is the redeemable. That is the certain. That is the agreed terms. Okay. Then we will move to the other discussion in our overview. That is the first one. This is the second one. Thereafter third one. What are the methods or mechanism to calculate cost of capital? What are the methods or how to calculate the cost of capital? By using each sources. Here we have to know about the techniques to identify cost of capital. Then that is the major part of our topic. Then we have to identify what are the methods, how to calculate That means we have to be incorporate with the techniques to identify the each sources. Then last discussion, this is the WACC, weighted average cost of capital. Weighted average cost of capital. We will take the first letter of the each words. Then that's why we call as the WACC. That means we have to weight based on the what? That is the main thing. Normally we will calculate the WACC based on the market information. If it is a market information is not available, we can calculate the, what is the method? Historical. Historical means statement of financial position figures. If you don't have observable market or reliable marketing to get those information to calculate each sources, then we have to work on our historical figures which is available in the statement of financial position. Normally we can say in the balance sheet. Those figures we can calculate our cost of capital. Now when you are working in the particular organization, then your organization has not been registered under the CAC as a quoted public limited, then you are company working as a private limited. Then you don't have available resources to get the market information. Then you can get the similar company available in the share market, then get those information and you have to modify and get your cost of capital. But those techniques will not discuss in our syllabus. It will be available in the later discussion in your professional career. Then you will be able to learn those things. But keep in mind, this topic will be available in the overview of our discussion as well as the overview of your life journey in the management accounting finance. That is this topic mainly available in the finance management as well. But keep in mind, these basic things you have to be careful when evaluating each cost of capital sources. Each source there are mainly there are three sources: equity capital, debt capital, short term discussion is not available in here. Why? Those cost, overdraft, short term loans, those are the shorter period we will collect money, then that is that cost is consist in at that time, then no need to worry about that. But those are the main sources, equity capital and debt capital. Then we have to evaluate what is the cost. Then ordinary shares, preference shares, redeemable, irredeemable, debentures, likewise. Because why I am taking those mainly A, B, C and D under the debenture? Those are the marketable instrument. That's mean when you evaluate in the Sri Lankan context, ordinary shares, preference shares, debentures are marketing. That's the marketable instrument. That means those instruments are traded in the where? Colombo Stock Exchange, CSE. Then you can get the information as a practitioner, as a professional. You can evaluate those information. But here in our topic, that's in our syllabus, will not take about those information. But you need to memorize those information. When we calculate in the back, you have to get the information from the market information. Fortunately, in your paper, those information will be provided. Then you have to do in the simple thing, get those information and do the workings and get the answer. No need to worry about those things. But as a profession, you will be going to the outside of the academic information. Then you have to get those information. That's why I earlier informed you what are the area you have to bring those your real information in the world. Then you have to be, that's mean adjusted based on your requirement, and that means you have to be shuffled and put into those spices likewise. Then get the particular weighted average cost of capital. Then we will move to the other part. Okay, now we will take one by one topic to evaluate those situation. Okay, first topic, equity capital, which is equal to the ordinary shares. Normally ordinary shares holders we consider as the true owners of the organization. That means those are the owners actually right to control business. Okay, that's why we using that word true owners. Before moving to this topic, I will show some basic idea about the sources of funds. This is the traditional balance sheet or statement of financial position. Okay, statement of financial position as at 31st March 2023. We will take whatever the PLC, blah blah blah, PLC. Then non-current asset. Under the non-current asset, there is a property, plant, equipment, some figures. Then investment. Then intangible assets. Thereafter current assets, inventory. Normally we can say the stocks, no. Then trade receivable, other receivable, cash and cash equivalents. Then you can take the total assets. Total assets. Thereafter equity, ordinary shares, preference shares, irredeemable. Then retained earning, or sometimes there will be the general reserves, revaluation reserves, likewise, don't bother about that one. Then non-current liabilities, debentures, long-term loans or borrowings, likewise. Thereafter current liabilities, trade payable, income tax payable, accrued, likewise. Then total asset should be equal to equity and total liabilities. That is the basic account equation, no? Okay, these are the method we are collecting funds. Very easy, no? Then you can say very easily, these are the method we will collect. We will, as an organization, we bring the cash to the organization by using this method. That means our available cash balance is available, mentioned in here. Don't bother about that, I will explain later. These are the method. If I want to expand my business or to run the business by using the day-to-day activities, then I need to money. Then I can collect money from the ordinary shareholders. It is not enough, then again I can go to the preference shareholders. The preference shareholders I can divide it into the redeemable, irredeemable, likewise based on the condition, based on our agreement. Then retained earning. Retained earning means if I earn profit, I will not distribute among the shareholders. It is keeping future purposes on behalf of the organization. That's why we call as a retained. Earning has been retained to future business activities. Then it is not enough. Then again I can think about the outside parties. This is the inside parties. Now this is the internal parties. Internal. This is the external parties. If it is not enough to internal parties supporting, then I have to think about the external parties point of view. Then I can go to the external parties, debenture issue, and collect the money from their purse or their pocket. Then I obtain money. Then I have available funds. That is my funds. Yes, I have this much of funds. Then I have to purchase land and building. I can invest somewhere else. I can acquire the intangible assets. I can purchase the stocks. Trade receivable means the credit sales. Other receivable, likewise, I can invest. Then these are the funds available. All the funds available. Then I can distribute. This is the investing. That is the financing method. That is the financing. This is the financing. That is the method bring the cash. Then these are the investment. In this topic it is not available, but keep in mind this is the financing, collecting monies, collecting cash. Then I will be invest somewhere else based on the property, plant equipment, investment, other organization, intangible assets, stocks, trade receivable. Likewise, I will spend that money on behalf of the future purposes. Then this investment should be not at all for our all funds. That balance will be available in the cash and cash equivalent. That's why we normally recognize balance sheet should be, that the sheet should be balanced. That's why we call as the balance sheet. But later it has been changed, statement of financial position. That is the word, statement of financial position. Those days we call as the balance sheet, but nowadays we call as the statement of financial position. Why? That is the my financial strength has been provided based on the, these are the my collecting money method, these are the my investment. Likewise, then here if it is a some outside person point of view perspective, they invest money somewhere else. Where do they invest? On behalf of them, they will trust by myself, as an investor point of view myself, then they invest money on behalf of me. Then my business should be running the smooth and as well as they enhance the future business activity. Then those parties will be provided free of charge their funds? No. Then we have to careful their interest. Then we have to pay some fund. On behalf of the ordinary shareholders, we have to give the dividends. Preference shareholders, we have to pay the preference share dividend. Yes, we can say preference shares dividend. Debenture holders request interest. Then those are the cost on behalf of the collecting money from the outside person. Then we in our topic, did you remember that? Cost of capital now. What are the capital methods? These are the capital collecting methods. What are the cost? On behalf of the ordinary shareholders, dividend. Preference shareholder, preference shares dividend. Debentures, interest we have to pay. But here we want to know about the as a percentage. Then dividend will be paid some amount money as the accounting point of view. LKS 10 reporting after the balance, that is the event after the reporting period. Then those information we will be recorded as per the accounting standard. But here we want to know about the, we paid dividend. What is the percentage? We paid the preference shares dividend. What is the percentage? Interest paid. That is the interest amount paid. We can easily, it can trace by the cash flow statement. What is the interest amount paid? Then, but here we want to know about the as a percentage. That's why we are looking as a percentage those costs. If we know the dividend, we can say the dividend amount, this much of amount likewise. But problem is we have to have what thing we have to do? We have to have what we call, what is the word that we have to use? We have to compare. If it is this equity holders provide this much of percentage, another equity holder, they also willing to be part of our true owner, but we need to know about the what is their expectation. Existing shareholders and that is the future potential, that is the what we call in the possible order shareholders in the future, what are their expectation. Then we have to compare. This is the existing cost. Then if we again issue a shares, then what kind of cost we have to incorporate that shares, then we can compare. If it is the lesser, then it should be very attractive to our point of view, but investors point of view it is a distractive. Why? It is not encouraged. Why? Based on the investor also evaluating their existing pattern, that's why they are willing to invest in our organization. Then we also have to look at what is the percentage we will pay dividend as equity holders. Future investor also looking at what is their historical background, that is the trend, normally we call as a trend. Then investor also look at what is their historical pattern, then it is possible to earn more than that, then I will invest there. Likewise they can think, then those expectation should be matched. This is the investor's point of view. Here business point of view, this is the source of funds, this is the investor's point of view. When we look at in the equity capital, did you remember I told you cost of equity, where the party cost will be in the dividend. However, as a business organization we will cost, we have to pay some dividend to the outside party, it is the cost to the organization. Then here dividend is KR or KE, yes KE. I think if I not mistaken, please change that our short note also the KE, okay, KE, equity, cost of equity. This is the Greek word K, we are using cost of equity. The investor point of view, they will earn in something, some benefits, no, then we call as a return on equity, on behalf of the equity we invest as a investor point of view, then I will be receive the return, then we call as return on equity. That's why we use in the abbreviation RE. Those requirements should be matched. Then a particular organization point of view, we can bring those information and calculate what is the dividend percentage we are planned to pay, or what is the historical, based on the historical trend, what is the percentage we have already paid. Then investors also, if it is the investor provide money to the organization, they also get our historical information and evaluate those factors, and then they will identify that this is my minimum percentage. Then business organization should be comply with their minimum expectation, otherwise they will not attractive to provide their money to the organization. Then our cost also should be the attractive rate to the on behalf of the investors, otherwise they will not attractive, then they will be discouraged. Then we have to encourage in the good percentage, maintain the good percentage. That's why every organization try to pay every year dividend. That's why based on that, then investors also will be encouraged. This organization will be provide year by year some amount of dividend. Then as an investor, if I invest this organization, I can earn something from that. If this organization they never paid the dividend, then there is a risk behind that. Likewise, particular investors think about. Then this is a very practical topic. Then you have to have memorized. Our point of view, it is the cost. Investors' point of view, it is the return, it is the benefit. Those requirements should be met. In our topic, we call as the KE, that is the cost of equity. ORE, equity holders, what are the expectation from point of view, investors point of view. Now we move to the how to calculate the cost of equity. Before going to the cost of equity, that the equity means the ordinary shares, no, then that is the ordinary shares. Then we have to identify some features, characteristics, some characteristic to the ordinary shares. First one, voting rights. That means if it is the organization will be taken into some decision that the board meeting, then ordinary shareholders can make a vote based on their what, number of shares. Based on the number of shares, they can make a vote. That is a major benefit to those who are in the investors point of view, in the what, ordinary shareholders. Then second one, you can make a note, as well as I will provide some tutorial in relation to those this topic. Then you can go through and highlight those relevant area and make a short note, as well as by using this method, voting rights. Then that is the voting rights means the ordinary shareholders having the having a voting powers too. Then second one, dividend payment. Dividend payment. Dividend payment. That means ordinary shareholders are entitled to get some dividends based on their profit. If it is the enough profit, then board of directors will be decide. Board of directors will decide to 5 rupees per share. Then in annual general meeting, shareholders will approve this one, then we have to distribute. Board of directors means management. Board of directors means the management, no? Then administration person, people think about in this year, that is 2023, we can distribute 5 rupees per share on the ordinary shares. Then those decisions will be coming under the annual general meeting. Then annual general meeting, all of the shareholders will be coming participate that meeting. Then they will approve. Then we have to distribute the ordinary shares. Based on our declaration, we cannot make a payment, but there should be a approval in the financial accounting terms. But management accounting point of view, we want to know about what is their existing dividends. Based on that, we can expect, we can predict. That's the dividend payment. Third one, limited liability. Limited liability. What is that word? Limited liability means? Limited liability means ordinary shareholders having some liabilities, but they can go beyond their value. That means if I purchase some ordinary shares from the particular organization to worth of the rupees 10,000, then my liability will be coming to maximum 10,000, not beyond that 10,000. That is the word. But keep in mind, some shares are having unlimited liability. In Sri Lankan countries, I have not seen in the unlimited company. Every company has having a limited liability company. No? If you see the company name, private limited, public limited, limited by guarantee. Likewise, those are the limited. That means limit means we cannot go beyond the investment amount. That is the third one. That is the third one, limited liability. Fourth one we can say, what is the liquidation rights? Liquidation rights. Actually, it is not the benefit, it is the negative. That is the disadvantage of the, if it is a particular person as a ordinary shareholder, that is the major disadvantage, drawbacks, negatives. Why? Liquidation rights mean if it is an organization management or organization will be taken the decision to wind up our organization, then they will collect all of the assets and sell, then collect the money. Thereafter, they have to settle their liabilities. No, there's a preference. Mainly, they will think about initially they have to settle the outside liabilities. If it is finally they will think about the ordinary shareholders amount. If it is not available enough money, then that losses will be available the ordinary shareholder. That is the liquidation rights. Liquidation rights mean at the time of ending, wind up the particular organization, and if it is a particular cash is available, then it is entitled. Otherwise, they have to sacrifice their investment amount. Okay, those are the main features in the apart from that, there are another one, if I am not mistaken, that is the preemptive rights. Preemptive rights. Preemptive rights mean the company, if it is the preemptive, yes, we will discuss that one also. Preemptive rights. That means if it is an organization already having the existing shareholders, then company think about again reissue another issuance of the shares. Then organization will call to the existing shareholders, ask from their expectation. If it is they are willing to purchase the new shares also, then they can take. Those are we call as the right issue, bonus issue, likewise. Those are the pretendable rights. Okay. Now we move to the how to predict or forecasting cost of equity or equity return on equity. That means we are trying to identify the KE or RE, KE, cost of equity, on new share issues as well as the retained earning. In here, when we identify the KE or RE, we are not incorporated to the calculation of the retained earning based on that one. Why? It is the foregone. That is the that means that is the opportunity cost. Foregone means that if we not distribute the earning profit to the shareholder, we can retain. That's why I already informed to you. Earning retain. Retain means we kept without distributing the ordinary shareholders. Then it also having the some cost. We have not distributed to them. We keep kept that funds from the future businesses. This is the opportunity cost. But here, as a cost of capital identification, we never taken into the consideration to calculation our here available the opportunity cost. Okay. When we come to the new share issues, there are two methods. There are two methods based on the dividend as well as the capping. This technique still has not been tested in our exam. Capital asset pricing model. Capital asset means the ordinary shares capital is a capital. No? That's why we use in the capping. Capital asset pricing model. Capital asset pricing model. Capping. Under this technique, we have to calculate. Based on the dividends, there are three. No growth. That means same dividend. Same dividend. There is no any growth. Second one, constant growth. Third one, multiple growth. Here we have to identify the growth means the G. Growth rate we have to identify. In our syllabus, multiple growth will not be tested. It is not covered under our syllabus. Those two will be tested in there. The constant growth, normally growth will be growth has been identified by the Gorton, that is the person. Normally we can say Gorton growth model. Gorton growth model. That is the person identify. That's the finding that technique. Okay, based on the dividend. Normally dividend we can say dividend no. Then we use the capital D. But here very easy to identify the simple D. We will use it as to mention the dividend simple D. Okay, no, simple D. Then if it is the particular person like to be a shareholder of a particular organization, then that potential future shareholder think about evaluate their existing dividend pattern based on the, if it is this organization has not been dividend has not been gradually increased, then there is no growth. Same in the constant growth means dividend is same but growth rate, that the increment percentage 5%, 5%, 5% every year, then that is the constant growth. Multiple growth means this year 5%, next year 8%, thereafter 7%, next that's the another that the year for 20%. Likewise, multiple different growth rate, but those are not available in the our syllabus. But practically these are the area we have to be carefully evaluate. Then those two will be tested. Okay, please make a note that one. And thereafter, under the capping method, we will take the risk available of the particular organization as well as the market. Firstly, we take the risk-free rate, risk-free rate. This will be abbreviation by RF, risk-free. Risk-free rate means the treasury bond rate. Risk-free rate. That means if it is a particular investor risk-free, that there is no any risk. Where if they invest in the government bonds, if it is a particular person invest in the government security, there is no risk. Why? Government has a power to print the notes and settle their dues without hesitation. But it will be an impact to the economic side in the inflation, everything will be destroyed. But government is the only party print the notes and distribute to public. Then if it is a particular investor in the government security, there is no risk. Then we call as there is a risk, but government will be take that risk as based on their dominant power. Then we will take the percentage. What is the percentage? We can say 16% nowadays. More than that, okay. Thereafter, risk premium, RM. How we take the risk premium? Sorry, RP, risk premium. Risk premium will be calculated based on what? We have to get the beta factor, beta coefficient, risk of market minus risk of preferential risk free rate, that is the percentage. We assume 5%. Beta is 1, this is the 21%, for example this is a 16%, then difference is a 5. Beta factor should be more than normally 1. Normally if it is that means market information and organization information move based on the same pattern. We can say if it is our organization takes some decision, then market also behavior same thing, then that is the 1. If we take some decision, our organization will not react, then the lesser amount, then less than 1. If it is the market will be take some decision, our organization will react more than that, that is the higher, more than 1. Then generally beta factor is 1. If it is more than that, less than that will be, but keep in mind if it is 1%, no, then what is the their KPM? That is the 21%. 21% mean this organization, if we particular investor invest this organization, that person requests 21% percentage. If it is a particular person invests the 100 rupees, we have to give the 21 rupees end of the year 1. Otherwise, they will not available with us. That's the major thing. Okay, then I will show you the simplest way to evaluate that KPM model. Very easy by using the formula. Then KPM method R equal to return on equity, risk free rate plus beta factor, open bracket, risk of market minus risk free rate, that is the difference, same F. Risk free rate, this is the beta factor, this is the risk of market, this is the same thing, no need to worry about again. Then that is the cost of equity based on the capital asset pricing model. Okay, now we move to the dividend evaluation. That is the topic we have to think about. Okay, now we will discuss the dividend. Based on the dividend pattern, how we identify the cost of equity or otherwise return on equity. Now we will discuss the cost of equity by using few of the example in your study text. Thereafter I will be share the another tutorial as well. Then based on that you can master those area. Okay, Firstly, there is no growth. That is when if it is a G is 0 growth, there is no growth. Then here we will take the dividend. That means just now means year 0, just now year 0 we will purchase the particular share no, in as an investor point of view. Here we are talking about the investor's point of view, not the company point of view. Investor's point of view, minimum rate which is equal to the company cost as well as. Then year 0, just now you will be purchased as the investor. What is your price? That is the purchase price of the particular ordinary share. Thereafter, when we completion of the 12 month, it will become to the year 1. At that time, they will be provide some dividend. Year 2, same dividend. Year 3, same dividend. Year 4, same dividend, until infinity. Up to the infinity period, we will receive the same dividend. Just now also having the same dividend, that is the D0, same dividend we will receive. Then how we take the as a percentage? Then here, this is the basic mathematics approach. Those dividend payment should be equal to the that's the whatever the dividend payment present value, today's value should be equal to the this one. That means our answer should be 0. Then if we want to this answer to be 0, we take example. We will purchase the ordinary shares by 90 rupees. We will receive the 5 rupees wise. 5 rupees wise we will receive infinity period. Then we want to take the here answer to equal to the 90. That means present value of the future dividend payment. Present value of future dividend should be equal to what? 90. Then our answer should be 0, no? Then if we want to this answer should be 90, what is the rate? This is the future period, no? Future period. Today terms we have to discount. Then we have to divide it by particular rate. Here also rate. But unfortunately we are focusing on the same rate. That is the technique. That is the theory behind that. Then how we decided what rate should be to equal to that 90 in our example. Then I will take the symbols is 0. Then normally today price which is equal to dividend divided by R or RE. Here we are looking to identify the RE. Then cross multiplication. RE equal to D0 divided by P0. Then we will take the what is the D0? D0, P0, REO, KE. Cost of equity, current share price, dividend. Those are the words we have to identify. Then you have to memorize this is the equation, this is the formula. But basic formula, this is the today price should be equal to the dividend divided by the our required rate. Then RE, cost of equity, equal to the, if there is no growth, D divided by P0. Okay, we will move to the question number 1. Question number 1. Company pays 3 rupees dividend per share for a year. The market price of the share of this company is 25 rupees. Okay, calculate the cost of equity of the particular company. What is the information? Company pays the dividend. Dividend is how much? 3 rupees. 3 rupees. Then market price of the share, that is the market price, no? Current price, share price is the market price. How much? 25 rupees. Here we want to know about the cost of equity. That is the word we want to know about. Then I will show as a presentation. Then year 0 we will purchase particular shares by investing 25 rupees. Year by year I will receive the 3 rupees dividend per share till infinity. Then I want to know about this 3 rupees should be equal to by discounting what rate. All of the 3 cash dividend payment, future payment should be made to the 25. Then I will be take the 0. This answer should be 0. That is the rationale. Then how we decide? No need to draw those things. You need to memorize. That is the technique. Based on that, this is the formula we have established. Okay. Thereafter, I will not take those kind of graphical representation. Then those information we have right dividend. Then our basic formula is current market price every time equal to the dividend payment divided by required rate. Here current market price is how much? 25 rupees. Dividend is 3. We are looking to know about the RE. Then cross multiplication. අපි මේකට කියන හරස් ගුණිතය කියලා. Cross multiplication. Then RE equal to 3 divided by 25. What is the answer? 0.12. That is the here very beginning I explained we want to know about the percentage, no? Then multiply by the 100. Then based on this information, these investors looking 12% on the if we purchase the particular company shares. That is the investors point of view. They are looking to 12%. If it is a particular investor invest 100 rupees, end of the year he or she will be expect 12 rupees. In organization, if we obtain the 100 rupees from the particular investor, then we have to pay the 12 rupees minimum. If it is not to maintain the minimum 12 rupees on behalf of the 100 rupees, they will be discouraged. That means they will de-invest their amount. Okay. Then we will move to the question number 2. Timma Limited, that is the question. Timma Limited recently disclosed the dividend of rupees 5 and yet to be paid. That is the disclose. That is the declaration. It is not distributed among the shareholders. It is announced. Yet to be paid. An ordinary share of company is trading at a rupees 30 per at the moment. At the moment means that is the market price. Just now, market price is rupees 30. Calculate the cost of equity. When you are reading this kind of question, you have to identify what are the words you need to memorize. Before moving to the method, this is the example number. That is the question number. That is the example number. Example number 2. Normally we know that is our basic. Current market price every time will be equal to the dividend payment divided by cost of equity, RE. Here, then we want to know about the words P0, market price, dividend. That is the word cost of equity we are looking to know about. Okay. What is the market price? Rupees 30. Dividend is how much? 5 rupees per share. Just that is the year 0. Then 5 rupees divided by RE, here 30. Then cross multiplication. RE equal to 5 rupees divided by 30. Here we want to know about the percentage, no? Then multiply by the 100. RE is how much? 0.12. 16.667. Okay, I will bring the another example, same information by using the, if it is a normal method, we can see here. Did you remember under this dividend payment, just disclose, no? Disclose, that is the announce, just to be paid, that means still not paid, to be paid, they are willing to pay. That means here this price P0, current market price, every time should be X due price. This price should be X due price, X due. Here just paid means that price included that 5 rupees. Then price, that is the market price 30, just disclose, so just to be paid means that price included, that means particular investor try to sell in the particular share, that market price 30 means still they have not received the 5 rupees per dividend, just to pay paid. If we sold, we are not in a position to collect that dividend, then particular investor try to get the 5 rupees on behalf of the new investor point of, then we will be included. Then we have to remove the dividend amount as an investor. Then what is the normal price? 25 price, that is the market price, that is the P0. Normally it is X due price, X due, that's mean here we call as the cum due price, cumulative dividend price, cum due and X due. Normally we are taking into calculation the X due price. If it is not information has been mentioned, we assume it is the X due as a question number 1, example number 1. Here market information is available, then we can do in this method as well. But keep in mind, this question has been mentioned, the just disclose, announce, if I am not mistaken, just disclose. So yes, disclose dividend 5 rupees per yet to be paid, just to be paid, that's mean to be paid. Okay, then what is the our changes, that the effect of our calculation? P0 divide equal to the D0 divided by RE, then 25 5 RE, RE equal to the 5 rupees into 25 into 100, RE is 20. Why we remove this dividend? Still not paid. Okay, then question number 4. Biotharu Limited paid the dividend rupees per 4% 4 rupees per share, and ordinary share will be issued at the 23 per share. The issue cost per share is rupees 3. Then this organization will try to attract the particular investor, those who are willing to, those who are interested to invest on behalf of the ordinary shares. Then this organization try to sell it, particular trading, then they have to incur some cost, then we have to remove that price, because of the particular investor know about this organization, that is this organization having some cost, then that cost also include the my price. Then investor point of view, we have to eliminate, remove that transaction cost. Okay, P0 every time equal to the D0 divided by RE. If it is the transaction issue cost is available, then what kind of thing we have to do it? D is how much? Rupees 4. RE, that is the word we want to know about. P0 is how much? Current market price is 23, which is included the transaction cost 3 rupees. Then we have to remove it, eliminate. Then RE divided by 20. 20 rupees. If I not mistaken, yes, 20 rupees. Then here notes. There are 2 points we have to note. What? First one, P0 should be X due price. Second one, if it is X due price is so in a cum due price is not available, then we can take it as it is. P0 should be without transaction cost. Without transaction cost. Those are the 2 points we have to memorize. Okay, look at and do the calculation.